Hi, welcome to Real Men of Real Estate. I am your host, Brian Fox of Fox Real Estate Group, and with me is my co-host, Stephen Matley of Coast to Coast Equities. Welcome, Steve.
Thank you, Brian. Good to be here.
Great. We are going to talk today about multifamily investing and specifically land deals and multifamily properties. So to kind of kick it off, honestly, this is something you have a lot of experience with, so I'm going to grind you real hard on real good answers. So, the first thing would be is talk about the different ways that you can get into a multifamily deal. And the reason why is because multifamily, although you have a lot of different units you can get invest in, typically the cost per unit and the overall factor of how these go together is much greater. So being able to do them independently as an individual person versus a portfolio is a little bit more complicated. Can you just kind of ease us into that, and then we'll get rolling on this multifamily process?
Okay, well, first let's kind of define multifamily for the purposes of this. We're probably not talking to the institutional investors out there where multifamily is a high-rise or multifamily is an 1,100 unit complex.
10, 20, 30 units.
Yeah, it's with swimming pools and rec facilities.
Totally.
No. We're talking multifamily that is probably a duplex, triplex, quad. You can get up into 5, 6, 7 units. Once you get past about 10, 12 units, you're probably out of what an individual is going to be doing. They're going to be more of a company at that point, I would think.
Right.
Because you're getting into, it's a lot more complicated, and the property management side of it gets a little more tricky. I will also tell you that when you're 4 units or less, that's residential for lending purposes. Yeah, and when you go 5 or more, now you're commercial, whole different set of rules. So let's kind of stick with the 1 to 4, the 2 to 4 units at this point.
Want to do the 2 to 4? Okay.
2 to 4 units for the people, because I think most of our audience out there probably is, if they're looking at getting into this, that's probably where they're starting.
I agree with that.
The more advanced stuff is probably something you move to after you've been into this and you got your feet wet.
Yeah.
And I would not recommend anybody getting into larger multifamily unless you're doing it as part of an investment group or a syndication or something where qualified, knowledgeable managers are running it, and you're just putting money in to ride along with the group.
Exactly.
But if you're going to get into it yourself, start with a plan of what your outcome is. Now, I actually just talked with one of my investors today, and he's acquiring a multi-unit. And the idea of acquiring the multi-unit is he will rent 3 of the units out and live in one of the units. So he's actually it's going to be his residence. Now this gets a little tricky depending upon how you're funding it, because it's 3/4 income property and 1/4 residence.
Right.
So let's say, for example, that there's ways to invest in it. Let's say you're investing through something like your self-directed IRA. Well, your self-directed IRA cannot be used for your personal residence. It can only be used for income property.
Right.
But there's a way to use the self-directed IRA for financing 3/4 that's going to be the investment part, and having the other quarter be through some other form of traditional lending. That can be done. And you'd have to keep that separate for tax purposes, but it gets a little bit complicated, I would think, at this point. So you have to kind of look at what your end game is and why you want to do the multifamily. Most people that buy it are going to buy the multifamily to just rent it out as income property. They're probably not going to live in it. And in that case, it's strictly a business enterprise. Now, how do you get into it? There are several ways. As I already mentioned, you can go through a self-directed retirement account or self-directed health savings account if you want to, where a lot of people, if they don't know what that is, we've actually discussed that on some of our previous shows, but that's where you actually have a retirement account, not your regular retirement account or your 401k you got through your employer. You cannot do that through there. If you have a regular SEP or simple IRA, you cannot just go invest in real estate. But if you have set up a self-directed IRA, which is specifically for you to manage in a portfolio, you can buy a lot of different things. You can buy stocks and bonds and precious metals and real estate, lots of different things in there. And then you use that to buy real estate. You are not getting the dividends from that. You're not going to get monthly cash flow out of that property, but it will build up your retirement account. You're investing it instead of putting in mutual funds. That's one way to get into it. Another way to get into it is actually use your investment capital that you've saved up, that is your money that's going to be taxable, and you would put that money down. Like I say, if it's up to 4 units, it can be a conventional real estate loan for the balance of that. You would get into that, and then again, are you buying one ready to go? Are you buying one that you need to fix and to get ready to rent out? So there's going to be a kind of a fix and hold sort of a deal on there. Again, know what your plan is. As we talked in previous shows, anytime you're getting into something you're going to fix, you need to have a plan of action, a budget, a schedule, know who you're hiring to do the repairs, all that kind of stuff. So it gets more complicated. But there's a lot of ways to get into multifamily. I would say start with a real estate agent that knows the multifamily market. Okay, and I mean really knows the multifamily market where you're selling. So, for example, you're in Orange County. I know you've probably done some multifamily up there.
Yeah, quite a bit.
Okay, and so you know the layout, and so if I'm buying somewhere in Orange County area, you know the lay of the land. I would contact someone like you. You probably are not going to be much help to me if I'm buying the same property, say in San Luis Obispo. That's not your market. You don't really know what the values are.
Typically not. No.
You could represent me if I asked you to, but you'd probably have to go find someone else up there that was more of an expert in that market.
Yeah. So, and the thing, this is very interesting, but so if we're focusing on 2 to 4 units, right? Because that does fall under residential, the mindset of the customer and the competition around that product is significantly different.
That's right.
So I do have some clients who I hunt and shop for based upon 30, 40, 50 units, but their math is just dynamically different. And typically what happens is those units, I mean, everyone knows what the price should be because it simply comes down to math.
And it's not their first rodeo.
No, but I mean, but the people selling it either, it's like if it's a 30-unit building, based upon rents, costs, it's all calculated in.
Per door
this
price
is the price, and everyone understands it. So there's not really a lot of this negotiating. Some people may try and come way under. Some may be a little bit okay going over because they have appreciation or long-term value that they think they can do, or a value add. But typically in the residential, the 2 to 4 units, you can swing that quite a bit depending on what you think you can do to increase or decrease the demand for that product.
Right, and the chances are they're probably not owned by some big institution.
Absolutely not, no. As a matter of fact, we have clients who are flipping those right now, but they're flipping them to the number one customer for that particular item. So if they found one that was needed to be fixed up, they would fix it up, they'd re-rent it, and the best customer for that of an overpriced unit property is someone about to trade in a 1031.
There you go.
It's somebody, go ahead.
And then there's another, we talked about how to get into it. 1031 is another great way to go on that, because when you're moving up, you can actually come out of a single house that you bought that you're renting out, or a condo, and you can 1031 into that multi-unit.
Right.
And that's because the 1031 really is designed to step up to a larger property.
It was designed by the IRS to allow people to reinvest, to keep buying.
That's
to invest and become more affluent in their real estate portfolio so that the economy keeps growing of scale. So a 1031 exchange basically is that if you have an investment property and you sell it, instead of being tax capital gains, you can take those monies and put it right into a new property and step up and in within a certain amount of time and not pay tax on your income.
Right, but it's the 1031's a like-for-like deal, real estate for real estate.
Correct.
Because you can 1031 other things like
art,
stocks, but stocks to stocks, and art, those kind of things. Now, that's important to understand because another way to get into this is through syndications. Okay, so in a syndication, that means that you're not actually buying the property. What you're doing is putting money in and you're buying shares of a company that owns the property.
Right.
And in most cases, that's going to be an LLC.
Right.
My company uses these all the time for our projects. And what we do is the LLC owns the property, the managers own 50% plus of the LLC, and then we sell the balance off of shares to investors who come in so that they don't have to learn the ropes. Now, multifamily, if they're new in real estate, it's probably not as complicated as the deals we do. We do land flips, entitlement projects, which are very complicated. So syndication works really well for us, for the investors to get into that. But for the multifamily, you can actually pool resources. Let's say even with people you know. There can be, you and 3 friends that all put money together and form an LLC, and all of you are 1/4 owners of this LLC, which then owns the real estate. It also provides a liability shield for you.
Totally, and I think the only reason we don't see more of that is because it's a little bit more complicated and no one just decides to talk about it in general.
And honestly, it doesn't take much to set up an LLC. Contrary to what people think, I set LLCs up all the time. I can do them in a week to a week and a half. I can do them for under $150. It's not a big deal.
Totally.
Actually winding down the LLC is more complicated than starting it up. You have to get a separate EIN for it because it's a separate entity, so it's its own tax ID, and you'll get a K1 every year to go in your taxes. But when we go to that 1031, if you had your money in that LLC, if that's what you invested in, you would not be able to 1031 your share of the LLC to real estate.
Right.
You would have to 1031 it to shares of another company. Or the entire LLC could 1031 that property to another property.
Right.
See,
you have to work as a group.
You work as a group, that's right, because it has to be like for like. And I will tell everybody home, there are tax attorneys that deal with this stuff and tax accountants.
Yeah, let's get that out there.
Talk to them, okay? That's not me. I know somewhat about this because of my experience. I do have an MBA. I've been in this business a long time. You know a lot about real estate.
Sure.
We would not purport ourselves to be experts in tax law.
Correct, I'm with you. No, that's a good point. And so with regards to forming the LLCs, getting that stuff, I think what we need to talk about is just briefly before we go to break, is phasing the next segment is the very simple structure of how many people you want to get together, what's ideal, how much each person should put in for down payment, and what that would look like in purchasing the next part of the project.
Okay. So again, what is your outcome on a 2 to 4 unit?
So, no, I'm with you. We will get into this. We're actually going to take a quick commercial break. This is Real Men of Real Estate. We'll be right back with you just after this.
If you love them enough to relearn math so you can teach them math, then surely you'll check nhtsa.gov/the right seat to make sure they're correctly buckled in the back seat.
You made your house a reality. Homeschooling yourself on loans, color-coding listings, and flushing every toilet in a 20-mile radius. If you can ace house hunting, you can do it for retirement. Get on track with tips at aceyourretirement.org.
Welcome back to Real Men of Real Estate. I am your host, Brian Fox, here with my co-host, Stephen Matley, and we are continuing our conversation we were having before the break on multifamily investing, and now we're going to jump into how to create not only a portfolio, but how to get the group together that's going to help you get to your next level. So, Steve, you were about to say something, and I'm sorry we had to catch up for a break, but continue.
Okay, so let's move forward. So we did talk about using a 1031 to expand the size of the property you own and the number of units you have. There's also expanding the number of properties that you own, or what they call building a portfolio. There are a lot of positives to building a portfolio. One thing, it's diversification to some level. Even though you're still in real estate, if you have one property that ends up with a high vacancy rate, everybody moves out at once, and you've got 6 other properties of people paying rent, that one property doesn't hurt you. If you have the one property and all 4 of your tenants moved out just coincidentally on the same day, and it takes you 30 to 60 days to get new ones in, you're hurting for a while as you got to keep covering the cost of that building and advertise to get new tenants in and do all the fix-its between tenants, and there's no rent coming in.
Assuming the property is in good condition when they left.
That's right, that's right. And of course with tenants, you always know there's something to do when they come in. You're going to have to repaint, you probably recarpet, at least at the basics, and probably have some heavy-duty cleaning done in between tenants, right? So if you start building a portfolio, that's the other thing is you can take the proceeds, because we buy these buildings and we're charging rent. Now, what you paid for the building isn't going to change over the years. It is what you paid for, and you're going to eventually be paying that down, any mortgage you had on it, while your rents are increasing, because rents always go up over time. Historically, we can look and the rents do not go down on the long, they keep going up. So you end up with cash flow coming out of your property, and you can take that, and you can even take equity out of your property if you wanted to. You can do a cash out refi if you wanted to, take equity out of your property and use that to put down another building and fix that one up and put tenants in it. And so now let's say we started with a duplex over here, we take cash out, we end up buying a 3-plex over here, we fix that one up, then we take some cash out of that one and buy a 4-plex over here, and we keep building these. And now we have a series of duplexes, 4-plexes, and triplexes that we're building our little real estate empire, kind of like Monopoly, right? Keep adding more to it. That's building a portfolio. We can do that individually, or we can do that through those LLCs. You know, you don't have to syndicate to use an LLC. I may use an LLC just because of liability protection.
Oh, sure, yeah.
So if a tenant comes after me for some reason, they're not coming after me personally. They're coming after some company, LLC, that owns the property. Also, as you expand and you build a portfolio, I think it's essential to have a good property management company. You probably don't want to be the property manager after a certain point.
I wouldn't.
It's a headache, honestly.
Yeah, I wouldn't.
There are people, I don't know why anybody chooses to do this for a living, but God bless them that they're out there, because somebody needs to do this. And it's not an easy job to deal with all these different tenants and all these different problems. And if all you have to do is receive the money and someone else deals with the headaches, they're the ones that pound on the door when the rent's late. They're the ones that go plunge the toilet. They're the ones that deal with the party, that the music's too loud, and you just get the money. That's a great deal.
I want to be paid for them living there, not be paid for fixing their toilet.
That's right. Yeah, or have to pay to fix the toilet.
Exactly.
That's right. So if we set that up, we start building a portfolio up. Now and again, using these cash out refis, that's not money you're taxed on. You're borrowing money from yourself.
Sure.
It's not income. And how are you going to pay that? Because you're basically borrowing money out of your building. So how do you pay it back? Well, you've got rental income coming in. But now you've got multiple streams of income, because over here you've got another building that you bought with that money that came out. As you build a portfolio up, you could feasibly have a tax-free income for quite some time if you don't sell anything.
So would you say the best, if we were to nickel this down, it seems like for most people I talk to, the first one's the hard one. After that, it dominoes.
But that's like anything we do, Brian. Everything starts with that steep learning curve and that steep income curve, right? The finance curve.
That's true.
It's a lot of expense, and it pulls our resources. It drains our energy.
Sure.
And we build and build, and we hit that the so-called tipping point, right? That was a book called that, right?
Yeah,
kind of
it's out there.
that phrase.
It's out there.
Okay. So you kind of hit that point where all of a sudden everything kind of momentum takes over, gravity takes over, and now it's just a cruise. So now it's giving us energy instead of sucking our energy out of us.
So to talk about that then, and that's exactly what I wanted to say, is that if we were to get that first one, so would you say the best, in your opinion, way of doing this is find one, improve enough each unit so you can get the rents up
That's right.
enough to increase the overall value of the property and simply take your investment out and go start over?
Right, and it's the level of finishes you're going to do are dependent upon the area you're in.
Right.
If you are in a
maximize
low
rent.
to moderately low income area, you're not putting granite in the kitchens
No.
and stuff. If you are in your neighborhood, in Laguna Beach, Newport Beach, those areas, you probably need to do some higher end finishes to justify being in that neighborhood.
But at the same time, when you do those finishes, the offset in that rent is pretty astronomical
Yes.
from where they could be at base level
Yes.
versus what you could do improved.
That's right.
And then that's such, you raising the value, you pull that investment out, and you go start searching for another site.
Right. So you do what's commensurate with your market,
Right.
in your area, and the kind of tenants you're trying to attract, and you do the nicest unit you can do within a reasonable budget that will give you the maximum return on investment.
Yeah. So I mean, I don't know if you work with the general number, but one of the numbers I've been told by some of the clients I have to do with 30, 40, 50 units is they said 20 to 25 a door, $25,000 a door in renovations to improve. That's their number. They look at that and say if they can do that and they can improve a couple things about the building itself, they can usually increase the rents pretty good amount if their tenants have been there a long time.
Okay, and again, that's going to be dependent upon your geographic area,
of course.
how large the units are.
This was in coastal
are
Orange
these
County.
studios, 1 bedrooms, 2 bedrooms? Obviously, that
Yes.
all makes a difference. However, let's use that rule of thumb because it's not a bad
say
rule
for
of thumb.
now.
It's right in there. Okay,
Yeah.
so if that's the case, if you bought a fourplex and whatever price it is, you need to add $100,000 to that purchase price for what you're going to have to do to renovate it.
Right.
It's a pretty easy calculation.
Right.
And I would go a little above that because it's always going to cost a little more than what you think. And anytime you do rehabilitations, when you open a wall up, you don't know what's behind that wall yet. You could find surprises.
Right.
There's mold back there or something like that, or you find out the building had asbestos in it or something, and you got all of a sudden you have something more to deal with. There's things or maybe you open it up and you find out, hey, there's plumbing leaking that nobody ever knew about. We've got to fix this.
Or there's
thing.
duct in this wall that we thought we could remove. Yeah.
That's right. That's
Yeah.
right. So an abandoned electric lines that's
Sure.
still live. There's all kinds of things we could end up with. So rehabs, you always pad it a little bit. My rule of thumb on those is you always pad it by about 15%.
But to be fair, this actually doesn't work everywhere on a renovation side because some places don't have our appreciation rates. They've
That's
got
true.
great cap rates. Capitalization rates where you can rent and make a good income on the money you put in, but they don't have as much appreciation.
And that goes into your strategy of how much you're going to put into fixing it
Right.
up.
Yeah,
Okay.
so-
when you have a high cap rate and a low appreciation rate, you're going to do the minimum. You want to keep it livable. You want to keep it nice and clean.
Right.
But I'm probably going with Formica tops.
Right.
I'm going with linoleum on the floors. I'm going with a medium grade carpet. You don't want to go with the cheap stuff. It'll
Right.
wear out, but medium grade carpet or something. Whereas if I'm in a high appreciation, and this is going to be the coastal counties of California, I'm going to go much higher end on that because the appreciation will more than pay for itself.
So then I guess what we're saying is we actually can get them there with more than one strategy.
Oh, yeah,
I can
absolutely.
still get you a portfolio. I can still get you multiple properties. You may not have to invest and pull out. You may just simply be able to invest nuggets at a time to acquire a rented property, and it's paying you the first day.
And this is the problem where if we take our cue from say a national show.
Sure.
There's national shows out there that do certain things, and if we try to apply that as well, this is what we do.
The
anywhere,
universal concept, right?
You might be 60% of that is accurate, but the other 40% is what's going to really burn you on it. So
Right.
that's why we really need to work with people in our local area.
Right.
We need to work with the agent in our local area. We need to work with contractors in our local area. We need to go to a design firm in our local area if we need a designer. Now, if I'm doing an inland area, just medium level building, I'm not going to hire an interior designer.
Well, actually, you had brought up a great point.
In Orange County, I might.
Yeah, maybe. You actually brought up a great point, though, because we're doing a deal in Alabama right now, and I was talking to the GC over the phone, and in our area, everything is open. Like, if it's not open, it's worth less. And when I mean open, I mean open floor plan concept, the kitchen, all the house sees.
It's not a galley kitchen with a separate dining room.
No, yeah,
Right.
but and I looked at the plans. I said, oh yeah, we can totally cut this wall. And he's like, I wouldn't cut that wall. And I said, why? He said, because people like to have a little bit of separation here, so people can't see all the way through their house. And we were talking about it. And I said, it is something to do with the crime rate in different areas. Is that because they need to have separation so they don't feel like they're totally exposed.
Oh, okay.
It still looks really nice and it's a great neighborhood. It's very up and coming, but there's a mindset difference of what's trendy.
That's right.
And so what I mean by that is that if you're going to be looking at projects, you don't necessarily have to do all of it. You just have to look at what's necessary for the area you're in based upon social standards.
That's right. That's right. Yeah, and geography plays into a lot of things. Even your mechanical, electrical, plumbing stuff is very different depending upon the region of the country you're in.
Sure.
I know for a fact that I don't deal out here in California with things like frost footings. We don't deal out here with oil-based heating systems and those kind of things, which is common.
Not a lot of
other countries.
water. What's the water one?
The two-pipe systems. With
exactly.
The radiators and those. Kind of
yes,
things.
water pumps, radiators.
Yeah, exactly. Yeah, we don't use a lot of that kind of stuff here in California. Actually, where I live in San Diego, because I live right on the water in San Diego, above downtown, I neither have a heater nor an air conditioner because I don't need it.
Yeah,
I really don't, because what's the temperature range in San Diego is 20 degrees all year long.
Right. Yeah.
Which is insane. And so for you people who don't live in San Diego, I'm not saying that to get you to come here because we have enough people here, but it's nice. Okay, that's all I can say is it's nice.
On that incredible note about San Diego, we're going to take a real quick break. Right after this, we'll be back with the rest of our conversation on multi-unit investing. Be right back.
If you love them enough to relearn math so you can teach them math, then surely you'll check nhtsa.gov/the right seat to make sure they're correctly buckled in the back seat.
You made your house a reality. Homeschooling yourself on loans, color-coding listings, and flushing every toilet in a 20-mile radius. If you can ace house hunting, you can do it for retirement. Get on track with tips at aceyourretirement.org.
Hi, and welcome back to Real Men of Real Estate. I am your host, Brian Fox, here with my co-host, Stephen Matley, and we're about to finish our segment on multi-unit investing. And Steve, just as we kind of wrap this up, we talked a lot about the schematics of how and what to do, but we really didn't talk about the who. Okay. Who are the people? How do you get to it, and what is required of you? Would you mind, just from your education and teaching and everything you've done, talk about the teams that you've seen form and how they work and what's the best combination of folks?
Well, the one thing people believe, a lot of it keeps people out of it. They believe that you need to have some kind of special skill, education, knowledge. I don't have a finance degree, I don't have a real estate license, I probably can't do these things. Most of the people I know successful in this do not have any of that. Actually, my partner, he's the VP of my company, he was very successful in real estate, and he owned a lot of different units too. A former Marine and a former CHP. So no real special training, never went to college. But he actually trained me in a lot of the stuff in real estate. He was my mentor for years.
But special forces training?
Not that kind of training, yes. Yeah, no, fortunately I didn't do the military or the police work. But so the key is, me too, I have an MBA. Mm-hmm. Now in my MBA program, they never taught me how to do this stuff.
Sure.
We had a general idea of budgets and estimates and finance and stuff, but not like this. You connect yourself with the people that know what's going on and have a proven track record, is what you do. Sometimes you connect with them and they become mentors, they become mastermind partners, they become business partners with you or whatever. Other times these are consultants that you actually pay for some of their help to come in. Say for example, the real estate agent that is going to be an expert in the area and the type of property you want to do, well, you're going to pay them through a commission for their help in acquiring the right properties, and they're going to help keep you from making a bad mistake. Same thing with your title person and your escrow person, your lender. You'll have maybe a good real estate attorney, and you probably need a real estate attorney and a tax attorney to understand how to function, how to make these things function correctly, how to structure them the right way. So it's really about, you don't have to know everything if you know who knows what you need to know, and pick the right specialist and put your team together. And again, it can be a formal team or an informal team to make this work. That's why these things don't happen overnight. See, the whole idea of I've decided to go into real estate, so I'm going to take the money that I've saved up and put in real estate, and in 5 years I'm going to be a mogul, is just unrealistic. It takes time to build up the people around you and the group that you're going to move forward with. And on some projects they'll be with you, and some projects they won't be with you. On other things you have this kind of people that you work with over and over again, not necessarily tied at the hip, but maybe that you use them for this project and then on this project over here and this project over here for their expertise. Even contractors and stuff that you need to work with. So you build your team up, and it takes time. The good news is, let's say that took 15 years to get to where you kind of got over the hump. Did you know that every 15 years the real estate price in Southern California doubles about every 15 years? So guess what? You got a double appreciation while you were learning that anyways, and you actually have room to absorb some mistakes along the way if you made them. And now you've got a team and you start moving forward, and this is where people really start moving quickly, is they've built something up. And we talked about the momentum factor. We get going, and now the more you can go and the bigger your portfolio and the more diversified your holdings are in the real estate business, and you've got expert, property managers helping you and that kind of stuff, you have a lot more room to make errors. If you make a bad decision on a bad project, it doesn't kill you.
Sure.
You can absorb that easily. If your very first project out the gate goes sour, it could be the end of your real estate investing, unfortunately.
Yeah, that's true. So, I mean, on that note, with regards to what you need to do, in a previous episode, we talked about getting educated.
That's
right. So you don't have to have a formal education, but education just comes from reading, watching, learning. And I think for me, what I found is a lot of people read and watch and learn what is available in excess, and they're not really paying attention to who's doing it now.
That's right.
Who's doing it now? Like who can I look at now who's doing this successfully and try and see closer what they're doing.
Right.
I've seen this in all kinds of stuff. And those people who teach seminars about how to do it, but they did it 5 years ago.
Or they did it 15 or 20 years ago.
Or that. But they're making money on how to do it now. That's where they're making money, but what they're advertising is their money-making machine, which was that stuff, which is not exactly the same.
And I've talked to real estate investment groups, and I know it probably doesn't go over well with who they bring in as other speakers, but I tell them, look, if somebody is selling you their system to get rich in real estate, you have to ask yourself, why aren't they using their system to get rich in real estate? Why are they selling their system to me to make their money?
Yeah.
If their system works, now I talk to groups, but I don't sell a system. I talk to them about what I do, and if they're interested, they can talk to me about whether they want to be one of our partners or get involved in it. And there's no pressure or anything like that, because I'm just sharing something out there that most people don't understand about, the land kind of deals that we do. We do land entitlement deals. Most people don't understand those. And I just explain this is an option for you if you're interested in it. And we're not selling anything. I'm not selling a system to anybody. If they want to look and see what we do, I have no problem with that. If they're one of our investors and they want to watch us, I'll share our system with them. There's no secrets. We're not doing anything unusual.
No, absolutely not. I mean, and that's the thing too, is it's not one size fits all. I mean, each person's coming into the game at a different level. So giving them one formatted plan saying, here's how you do it A to B, it just wouldn't work.
Find someone that has done it and is doing it.
Absolutely. Has done, is doing it. And I think the best thing too is also to get educated enough so you know what the truth sounds like. If you're looking at someone who's never done any multifamily deals, either their own or somebody else's, and they're trying to give you advice on that topic, I wouldn't follow it.
No, I wouldn't go to the doctor that says, I used to practice medicine decades ago, I'm going to pull the leeches out and we'll fix you.
Maybe more than decades.
Yeah.
On that note, we're going to say goodbye to you here on Real Men in Real Estate. I want to thank you again for coming by. It's been a great episode talking about multifamily investing. Brian Fox, your host, with my co-host Stephen Matley.
Thank you, Brian.
You got it. And we will see you here next time on Real Men of Real Estate. Be free to go and check us out on realmenofrealestate.com, Amazon, and Roku downloadable network on Fire TV. Thanks for stopping by.